about a minute till we go live. Oops. Just another 30 seconds or so. Wait for some people to get in. All right. Let's get started. Good afternoon to everyone on the East Coast. Good morning to everybody else. It's still morning out here in beautiful Idaho. Let's get started on this week's webinar. It is October 13th at about 12 p.m. Eastern. I am an associated member of T3 Trading Group, which is an SEC registered broker-dealer and member of FINRA SIPC. You should carefully consider whether trading is suitable for you in light of your own financial condition. Quick position disclosure. I've got a few more new positions on since last week when we last spoke. I think that the DCAN-G is new. I think that the GRWG is new. I think that VXRT is definitely new. That's a day trade that I got into today. Yeah, I mean, it's been an incredible month, really. It's been an incredible month and a half, because September we had that fantastic volatility, bottomed out the second half of September, and October has been really interesting, and we have absolutely exploded over the course of the last 3-4 trading sessions, but I'll talk about that more in a bit. First, about me. I think everyone knows me if you've been following along with the weekly seminar that I've been doing here. I've been with T3 for 10 years, love the company, I've had a great experience with the firm. I'm a professional trader with T3. I've been running my own trading desk for the firm for the last 7 years. I took over business development for T3 really at the beginning of this year, but on a day-by-day basis, I'm probably working with somewhere in the realm of 100 professional traders at the company day to day. Overall, things have gone really well. Love talking about markets. That's going to be the main thing that we talk about today. What I try to do with this weekly webinar session is a few things. So first of all, I'm obviously giving an update of markets and how I see markets at that given point in time. What I am also trying to do very specifically, just for the people who are following along each week, is draw out specific lessons from my approach to trading that everyone can learn from and just get a better understanding of how markets themselves function. And then, I conclude each webinar with a discussion of T3, professional trading at the company. We also have retail trading at the company as well, some of our offerings, and what you would need to do in order to potentially get involved with the team. So that's the story about myself. I mean, it's been an incredible year for markets. It's been an incredible year for myself. I know it's been a difficult year for a lot of people with coronavirus and everything. It's opened up a realm of possibilities for me. I've been traveling and trading and working in different places really throughout the entire country this year. So, I've been trying to make the most of a difficult situation. Right now I'm in beautiful Victor, Idaho. I don't know how off topic I'm supposed to get from trading in markets, but I'm right on the border of Idaho and Wyoming. Went hiking in the Teton Mountains on Saturday with my wife. We did a grueling 16-mile hike, 4,400 feet vertical up to the top of a mountain called Taylor Mountain out here. And we ran into this moose. Just want to tell you guys about this moose. I ran into this moose in the forest, basically, on the way up, probably a few miles into the hike. The forest was dense. All of a sudden I look ahead of me and I see this body. And he must have heard me because he looks up. And I just had a moment with this moose, this gigantic male moose, where we were just looking at each other eye to eye for a moment in time. It was incredible. And then he started charging at me. About 40 feet away, it just starts running towards me down the path. I'm like, oh my God. And I've done my research on what you're supposed to do with different animal encounters. My understanding is that an encounter with a moose is one of the few animals that you can actually just try to run away from. You know, for the most part, they're not really trying to attack or hurt people. They can be a little bit rough during their mating season. But this guy starts charging at me, this gigantic moose. And I turn around and I ran, and eventually he ran off the side of the path and left us alone. Thank God. And what an incredible experience. Then he's walking away and he's in the distance, and I can just hear the ba-bump, ba-bump of each step. It was like something straight out of Jurassic Park. I'm a city boy. I live in Manhattan. I've lived in Manhattan since 2004. I'm not, maybe some people who are following along with the webinar are used to moose encounters or bear encounters or anything like that. I'm not. For me, that was an incredible experience. Anyway, I digress. We're going to talk about trading today. This is my email address if anybody wants to reach out to me at any point to talk about T3, prop trading with the firm, retail trading with the firm, T3 Live. I can put you in touch with the right people. Talk about just trading in markets. Talk about hiking and your moose encounters. Reach out to me. I'm happy to talk about anything. Let's go to the charts. All right, let's start with the daily chart of the SPY, the ETF representing the S&P. So first of all, it's been an incredible month and a half. Really, all of this September and October. I personally have been trading really well recently. And, you know, if you ask anybody in my team, one of the things that I'm really honest and really upfront about is that I don't always trade really well. Sometimes I trade better than others. Sometimes I have a better understanding of the market than at other times. And everyone is wrong sometimes. Everyone gets caught flat-footed sometimes or misinterprets the market. That's normal. And that's why the key to this business is risk management. That's what I emphasize to my traders that I work with all the time. I say all the time, as a professional trader, what I am doing is 85% risk management, 15% reward maximization. Because when you're wrong, and I had a little period of time back here in July where I was wrong, it's about how you manage your risk. Because everyone is wrong sometimes. Now, it just so happens for September and October so far, I feel like I've been more in tune and more on point with the market than I have been in a long time, maybe even ever. It almost seems like every day I've just been calling the exact move of the market based on how we're gapping, where we're opening, like almost to the penny and with pretty exact timing. So I know that that's not going to continue forever. I know eventually the market will change footing and I'll be wrong at some point again in the future. But for the moment where things have been going really well and I've been on point with the market, I am taking advantage of it. So, you know, it started with this parabolic move here at the end of August into the beginning of September. This is when I was on vacation supposedly, but ended up having to trade every day because how could you miss this down move in the market? There's a few signs that we were peeking out here. First of all, just the parabolic nature of the move, which, you know, you could argue that this is a little bit parabolic most recently also. But the parabolic nature of the move is not something that can be sustained. When markets get extended, like they were here in the beginning of September, like they are here now, I've been spending a lot of time recently talking to my traders about momentum and extension and understanding that there are degrees of extension in the market, right? You could argue that even, I don't know, choosing a spot like here in the middle of August, that we were extended here. How do I measure extension in the market? I measure extension in the market by where price is versus the space between the 8 and 21 EMA. The space between the 8 and 21 EMA I consider to be equilibrium. So, back here in July when the market was between these moving averages, well, the market's trading at its technical equilibrium, it's resting, it's figuring out what it wants to do. Even here in the middle of August, when it was away from its moving average, that 8 EMA by just a little bit, I would say that the market was slightly extended. And then look what it did. It time corrected, it went sideways, it price corrected even a little bit back into that moving average, and then it set up for this incredible parabolic move. So you could argue that the market's extended here. It is, but by a very small amount. You could argue that the market's extended here. It is, by a larger amount. The thing about extension is that markets that are extended can always become more extended, especially when there is news or volume taking place, and that is the literal definition of momentum. Momentum is one of my favorite definitions, and to take a half step back, I don't want to get too beginner or too basic. I assume that I have an audience here of different, degrees of experience. You can break my entire trading down to 3 definitions. The definition of what a trade actually is, which my definition of a trade is something with a technical reason and a technical out. Out is our term for stop loss. The definition of trend. An uptrend's a pattern of higher highs and higher lows. A downtrend's a pattern of lower highs and lower lows. And finally, the definition of momentum, which is really what I'm talking about right now. Momentum means the greater the price, the greater the demand. It means that the more the stock goes up, the more people want to buy it, right? And that creates a parabolic shape. And again, the thing about momentum is that it can last for much longer than people expect. I think it was the economist Keynes who said that a market can remain irrational for longer than you can remain solvent. That is very true. Has not changed. So when you look at a market that's extended like this, that's gone parabolic like it did here at the end of September, sorry, at the end of August and the beginning of September, well, it could have kept going. You could have tacked on a few more solid green days here. Does anyone remember the Chinese market in 2015? Just go to a weekly chart real quick. Go back to 2015. The Asher is the ETF that I use because it represents, look at this. Look what the market did. It represents the Chinese A shares. Look what the market did back here in 2015 in China. I can't even see the top. I can't even see the top. I got to adjust my settings here because that's how fast and how hard the market went up. Right, this is a weekly chart. Look, the market was extended here, and it got more extended and more extended and more extended. So the thing about market extension and momentum is that it cannot last forever, but it can last for much longer than most people expect. Back to the SPYs here. How did I know that this day right here was going to be the absolute exact top? I didn't. But I did know that this move was unsustainable, and we did have other key features of this market that told us that this move was not going to last, which I've spoken about in previous webinars. First of all, the VIX. The VIX was moving higher along with the SPYs starting on August 26th, this entire last half of this run. That's telling you that something is wrong. Also, market breadth was very, very poor, with only a couple companies leading us higher. That also is a potential signal that something is wrong. And then guess what happened? Bam, the market came back down to earth very quickly. And what I was doing into this move was building into shorts more and building out of long positions for my swing trades. So I both day trade, I swing trade, I also have a quantitative strategy to develop, implement by hand into the market on a day-to-day basis. So I have a diverse approach and I have a diverse time frame to what I'm doing. And everything I do starts from the big picture and works its way down to the small picture. I think if you are even a pure day trader, you need to start big picture and work its way down to the small picture, because maybe on this day right here, the day where the market got crushed, you found a nice potential long pattern in some stock on a small time frame. Well, your probability of success in that trade becomes significantly lower because the market is getting crushed. And when the market sells off hard, it tends to sell off everything. So, trading, to break it down to another fundamental key thing, trading is about risk, reward, and probability of success. That is the formula of trading. Risk, reward, and probability of success. If you can risk 1 to make 1 and be right 60% of the time, you are going to be very wealthy in the long run. Most of the best traders I know are actually wrong more often than they're right, but it's their risk reward that makes up for it. So I think that risk reward is pretty simple. It's simple math, right? Probability is much more difficult because it's much more dynamic. There are so many things that affect the market at any given point in time, and you need to learn to internalize and understand all those things, see them all at once, and understand the effect to the marketplace. One of the most important, what I call layers of probability, these different things that affect any individual trade that you're involved in, is the market itself. So if you were looking to go long a stock on this day, even if you have a nice little chart set up, well, unfortunately, it probably didn't work out because the market was getting destroyed. And that correlation means that your stock probably went down and that your long trade probably failed. So even if you are purely a day trader, you need to start big picture and then work your way down to small picture. That's what I always do with my team. 3 heavy days down, buying opportunity on this day. To where? Back into equilibrium, right? That 821 EMA. Comes back down, and I believe on this day, this was the day that AstraZeneca announced that they were no longer continuing their trial. So after hours this day, we actually went all the way down to 330. So that made this equal lows. 330 became really important. You just can't see the low down here at 330 because, again, it happened at 4:30 p.m. instead of 3:30 p.m. Solid bounce back up into resistance. This was a Fed day, building back into shorts here. Got a little bit worried on this Fed day because we actually broke above these highs, stuck with the trade, and then we caught the next leg down to the downtrend. That downtrend then reversed, right? So again, what is the definition of trend? An downtrend, well, an uptrend is a pattern of higher highs and higher lows. You clearly have those higher highs and higher lows here. The market pulled back to here on September 8th. Is this a downtrend? On the daily chart, the answer is no. Maybe if you're looking at a 15-minute chart, you're finding downtrends in here. But on a daily chart, the fact that we went from here to down here, even though it's a big down move, that is not a downtrend because the market, what's the definition of a downtrend? A pattern of lower highs and lower lows. The market did not exhibit lower highs and lower lows over the course of these 3 days. It was just lows and lows and lows and lows. The market went straight down and then bounced, right? So our higher low became in here. And then when we broke below 330 support, we were positioned short for this down move, net short. Well, now once we broke this low, only really on this day here, on September 18th, am I confirmed to have what I would call an intermediate or short-term daily downtrend, right? I have a high, I have a low, I have a higher low, and that low broke, I'm guaranteed to have a lower low. Here's that next lower low, here's that next lower high, here's that next lower low, trend is continuing down, intermediate downtrend, but that intermediate downtrend is within the confines, or we could call this probably a short-term downtrend because it was really only a month, less than a month, within the confines of a bigger picture uptrend. So when you are dealing with different pictures on different time frames, one time frame is telling you the market's trending higher, one time frame is telling you that the market is trending lower, the winner tends to be the larger time frame. So we had a shorter term downtrend within the confines of a larger term uptrend, and eventually that uptrend won again, right? This downtrend breaks, this lower high gets broken here, and now we went into a few days of tougher price action in here. There were some individual stocks, some individual trades that my team and I were able to get involved in that worked out really well, that traded a little bit more independently to the market, but price action here was a little bit tougher. And now I started to get pretty bullish into this area because of the underlying feel of the market. What is the underlying feel of the market? What does that even mean, right? Well, you could call the technicals in here neutral. I would call them neutral, right? Not really bullish, not really bearish. Like we're just kind of in the middle of all this consolidation. Yeah, we have a bigger picture uptrend. We have this smaller picture downtrend. This seems neutral. But what happened under the surface? We had 2 days of consolidation. That's technically bullish in this area. That really tried to break to the upside on this day. And this is now the last day of September. Things were looking really bullish. We broke up. We were trending higher all day. We got above 333 and 335 in the SPYs. And then what happened? News came out from our wonderful government that no stimulus deal was going to get done, that they were far away from stimulus, and that afternoon the market sold off hard. Well, what happened the next day? The next day the market said, you know what? I don't care about these stupid politicians that are in Washington, D.C., who can't get anything done ever, and should all, Democrat, Republican, I don't care, get fired from their jobs because they don't get anything done. Market said, I don't care about that. We're bouncing right back up, and we negated that. And then what happened? Once again, now market is looking really strong. It negates that sell-off from no stimulus. Well, that night, the President of the United States gets coronavirus. Futures get smacked right in the middle of the night. Next morning we open up down big. I had been telling my team that the bears needed to get the market back below 331. Well, where did we open that day? The opening price that day is 331.70. The low of the day is 331.19. I was using 331 as support. So there's news here, but technically it was a common gap down into support, and it was a large common gap down. We gapped down, and you know, there's these different types of gaps. It's one of the things I work with my traders and teach my traders, just in kind of the training programs that I have here and everything like that, and understanding different types of gaps and what they mean from a supply and demand perspective. So this was a large common gap down into support. Technically that means you want to buy. And I know a lot of people on my team were worried this day. We're waking up in the morning, the President of the United States has a potentially life-threatening disease. Should we just dump all our long positions and get out of everything and short this market? It was a scary moment. What I talked about in the morning meeting that day was we need to be buyers off the open. It's a gap down into support. We need to come in, take advantage of this. This goes back to the conversation that I just had earlier with everyone here in the webinar about understanding extension, right? Where the market is trading versus the space between the 8 and 21 EMA. Because extension happens on different time frames. So the market gapping down to 331 with the moving averages at like 334. We're a little bit extended to the downside of the daily chart, but not really, especially from where we just came. If anything, we're pretty close to equilibrium. But on the smaller time frame, your 5-minute chart, your 15-minute chart, we were opening up very extended to the downside. And again, it's a common gap into support. All the technicals say you got to come and buy that day. So that's what we did. The game plan that day, so when I'm doing my morning meeting, when I'm talking about a game plan to my team, I always start big picture. I always give a broad strategic approach for what we should do on the market. The broad strategic approach for Donald Trump has coronavirus is, let's come in and at least be short-term buyers while the market's extended to the downside on the small time frames. If we get a price or time correction higher that satisfies that downside extension on the small time frames, and then the opening low breaks, then we know that we're in trouble. That's then real selling coming into the market. Then you got to get stopped out of your longs, maybe you could enter some shorts. But it's not what happened. Donald Trump got coronavirus, the president got coronavirus, and the market, the low is basically at the open that day, especially with a lot of individual names. We traded higher right away. We closed okay. And then the next day we gapped up. We got above that previous day's high. This day, it fully negated the bad news. And once again on this day, the market's looking tremendously bullish. Then what happens? Another news event, right? We have news event, bull day, news event, bull day, news event. Then the president comes out this day and tweets in the afternoon. The market was looking decently bullish in the morning, was trying to break out and give even further gains from the previous day. And then guess what happens? He tweets, No stimulus. We're done. We're walking away from it. Market gets crushed all the way back down. Still above Donald Trump coronavirus support, but market gets crushed all the way back down to its equilibrium area. Next day, they negate it again. That night, Donald Trump, who we all know watches the stock market, was like, oh my God, I sunk the stock market. I can't sink the market myself going into an election. So he starts saying stuff that night about, I am still willing to approve one-off deals and this, that, and the other. And the next day, the market once again fully negates the bad news. So why am I going over this in such detail? Because this is showing us the underlying bullishness of this marketplace back in here. This market wanted to go higher even back in here. We had bullish consolidation, break of the downtrend, bullish day, bad news, fully negated the next day, bad news, fully negated the next day, bad news, fully negated the next day. The market was telling us in this area, you know what, we don't even care. We don't even care about this bad news. Market wants to go higher. That's the underlying feel of the market. And based on all of that, on all of these pull-ins, building into longs. And then we finally get our breakout in the SPYs. Now, one of the really interesting things about this market recently has been the outperformance of the IWM, of the Russell 2000, which is more small caps and mid caps. So the IWM went first. The IWM broke out on September 5th and didn't care about any of that bad news. The SPYs didn't break out until like 3 trading sessions later on October 8th. And the Qs didn't break out until another trading session later on October 9th. So one of the interesting things about this market is, whereas in this entire post-coronavirus bear market rally, it's been tech that has led us higher, in the September pull-in and the late September through October bounce, it's really been the NASDAQ and tech that has shown weakness, and the Russell 2000 in value that held up best in the pull-in and then went first to break out. And then the SPYs broke out, and then the Qs broke out last. So, we had been positioned, I had been positioned for this move higher, increasing my long exposure on the market, really happy with this move up. And then it came into these last couple of trading sessions where, all right, now it's kind of interesting because this IWM was, again, extension, momentum, equilibrium, degrees of extension. I guess that's the big lesson from today's webinar, is understanding all of that. This IWM was extended here and got more extended and continued higher and continued higher. That cannot last forever, showing incredible relative strength. And what I said on Friday morning, which is this day right here, and the IWM was still up 1% that day. What I said on Friday morning to my team in the morning meeting was, the most bullish thing that could happen right now for the market would be some mean reversion short time frame. Let's have the Russell 2000 chill out, had an incredible move, got extremely extended, correct through time or price, and let's see the NASDAQ start to regain leadership. Let's see the NASDAQ start having some buying. Let's see some mean reversion where the NASDAQ outperforms the IWM and plays a little bit catch up. I think that would be the most bullish thing that could happen in this market right now. And guess what? That's exactly what happened. IWM started taking the rest. See here, even though it made new highs yesterday. So I think this day was up like 1%. This day, yesterday, I think it was up, not too much, maybe 0.5%. And the NASDAQ, meanwhile, was up like 3.25% yesterday. So we are seeing that mean reversion kind of take place. So for myself, I had built into some new positions, when I saw that underlying feel of strength into the market. I've got myself into a DKNG position. I got myself into, I added a bunch of new swing positions. I got Beyond Meat, I got Lennar, I got DKNG, I got GRWG, I got, what else did I add? I know I got several more. I'm in 22 positions right now. I think 4 of them are short positions if you include TZA, because it's a reverse ETF. So I'm net long this market, but the positioning for that was back in here. And what I've been doing into this move has really been mainly book and profit. And then what I did yesterday was I bought that TZA, right? To add on a little bit more of a hedge, shorted this IWM, looking for that mean reversion, looking for correction, because the market's extended. I've still got longs. I don't really have an interest in adding longs when the market is extended. So one of the things I was given a lesson about in yesterday's afternoon meeting is regardless of time frame. So looking at the IWM, just because it's what's in front of me right now on a daily chart, this could be a 5-minute chart, it could be any time frame chart. If I were to buy the IWM, let's just say somewhere in this area, and put a stop loss at one of these, little tail lows here, I don't like doing that. I always like my stops, whenever possible, to be below the 8 and 21 EMA. And if I have to buy a market that's all the way up here, I don't like doing that because the market's too extended. If you purchase an extended market or an extended stock, the only way that you will be able to make money from that is by having momentum continue to pay you, which can definitely happen, right? We just looked at the Chinese market from 2015 as an example of, extreme kind of momentum and extreme animal spirits coming to life in that scenario. That can happen, where you can, buy and extend territory and continue to make even more money. But generally, you're asking to get shaken out of positions that still work. So one of the things I was talking about with my team, I think just yesterday, was when I choose a stop loss for something, I need to choose a stop loss where I know that my idea was wrong. So I think one of my traders was involved in DKNG yesterday. I hope he doesn't mind me going over it. I don't think he will. And so this is today's 5-minute, right? This is yesterday's 5-minute. DKNG got a nice upgrade yesterday. It was strong at the beginning of the day. And it kind of was starting to build a bear flag here on these 2 bars. So I think the trader purchased off of these lows. The problem with that, what I'm talking about, is if your stop is above this equilibrium area, you have a much higher probability of getting shaken out of a trade and then having that trade work. Which in this case, the trade doesn't fully work. I can talk about why in a second. But let's just say that the trader's idea was right. That this thing builds out a flag, has this quick little pullback to closer to the 8 EMA, and then explodes and give another leg higher, which easily could have happened. Well, you just got stopped out of a trade that worked. And again, that can happen to anybody. We work in probabilities as traders. There is always the circumstance where you do all of the right things and you get stopped out at the low penny and you take a loss and then that trade works. That is a fact of life in a trading career if you trade for long enough. But my issue with that stop loss here is not that he got shaken out and it potentially could work. It's that the stop loss was not in a spot where if you get stopped out, your idea is wrong. So that's the question I'm always asking myself when I'm entering a trade and I'm trying to figure out where my stop should be. Where do I know that my idea is wrong? That's the spot I need to give it to. Eventually, if you were long this thing somewhere, maybe on the break of this wedge right here onto this bar, then you could have used this low or even this low as your out because it's in equilibrium, it's broken up to new highs. But if you were buying here and using this as a stop, it's so easy to get shaken out because it's still extended on its time frame away from those moving averages. The right stop where you know that you're wrong would be this low. This higher volume Maribozu candle where a lot of people bought the stock. If it ever breaks below that low, it's breaking through its equilibrium area, and all the people that bought in this bar are out of the money. They're taking a loss. They're having to sell stock, and buying and selling markets work in feedback cycles. So again, when I'm choosing a stop loss for any type of trade, I want to choose the stop where I know that my idea was wrong. And then I don't love that trade even to begin with because that trade's above $52. And again, it's right into the equilibrium area here on the daily chart. A much better trade in DKNG, which is where I got heavier in this position, was here, right? So this from, well, I guess this is Friday last week. Stock was getting really beaten up on bad news, had that secondary, which is always really bad for a stock because it increases the float. We're having more problems with sports, which is obviously, and coronavirus, which is obviously bad for the company. Stock got completely beaten down. This low is about 48.25 or so. Stock had come from 64 down to 48.25, more or less straight down. What creates this a good buy as a good buy? Well, this is your hammer capitulation buy setup. Strong confirming volume, strong tail. The only thing I don't like about this is I would like it to be a little bit more extended on a 5-minute chart to really confirm capitulation. And then if I'm getting into too much detail, I apologize. If you join the team, this is all stuff that you'll learn piece by piece. But this is where you want to be long the stock. If you're buying here at 48.60 with a stop loss at 48.25 and you're risking 35 cents in the trade, just to equilibrium, you have 1-to-1 on the small time frame. But now, see, what I'm constantly trying to do as a trader is find small time frame risk for big picture reward. So where can this stock go from here? So first of all, it's downtrending. The highest probability thing, because it's downtrending, is honestly that I get stopped out. But I'm buying it on the way up after I have a degree of capitulation. And what can be a good upside target for this thing if you're buying at 48.60? Well, again, a snap back into this equilibrium area, $52, $53, which is exactly where it went. So if you're coming in and you're buying this position here for 35 cents risk, you cover that risk into this initial move. And then if it closes well, it honestly didn't close as well as I would like to keep the position overnight. But if it closes well, you're looking for a move to $52, $53. So now you just risk 35 cents to make $4. Now that's the kind of risk reward I'm looking for. Again, that smaller time frame risk for bigger picture reward. So where are we now today with this market? Well, we're correcting. This is a correction day thus far. It's a tight, boring, inside day. I'm personally down a little bit of P&L today. I honestly don't care because I made so much into this up move that if the market wants to have a healthy rest and I'm giving back a small percentage of the P&L that I've made over the course of the last, handful of trading sessions, that's fine. It's natural. There's nothing to be upset about that. And look, the most bullish thing that can happen here now is continued mean reversion, like I spoke about, and this market goes sideways and let these moving averages catch up a little bit, set the market up for higher price action. Now, obviously, we have a lot of events coming up with the election going up. There's still some uncertainty around that, and we'll see how that plays out. That uncertainty has led to this increased volatility over this last month and a half, which for me, that's heaven. So I hope that continues, that uncertainty, because it's something that I'm able to take advantage of in my own trading. But right now, the market is just having a little bit of a rest day. The market's struggling to even price correct back down. The IWM did a little bit today and has bounced back up. The Qs are also just having an inside day, letting these moving averages catch up. All of that is continued bullish price action. And, we'll see how things play out. What I do with my team is we take it day by day. It's one day at a time. Every day we need to reassess the news, reassess the gap, reassess how things are looking, and just take things one day at a time and figuring out each morning, what is our game plan for today? What are we focusing on? And how are we putting ourselves in a position for success? So that is my update on markets for everyone for this week. Now let's just go into prop trading with T3, a little bit about what everybody needs to know. So first of all, T3 Trading Group is traditionally a proprietary trading company that is focused specifically on equity trading. Traditionally. We have expanded our businesses over the years. We have equities prop, we have equities options, we have futures prop, we have options on futures. We also have retail trading accounts. So my email address will come up again at the end. If anybody has any questions about any of this stuff, reach out, and I'm happy to speak with you individually about getting involved with us, getting involved with my team, Because if you open up any of those accounts, you can get free access to my training program, my virtual trading floor, my morning and afternoon meeting, some of Scott Ruther's stuff as well. So, T3 Trading Group, I believe, is one of the largest proprietary trading companies in the United States. We have over 500 professional licensed accounts. We have 6 physical trading offices, including our headquarters in Manhattan. That's usually where I am, but not right now because I'm out of the city. I may be back in January, maybe a little bit after January. We'll kind of see how things go. I'm loving it out here in beautiful Idaho. Going to South Lake Tahoe on November 1st. Finishing the drive, New York to California. And I'm going to be out there trading and working and skiing, which I'm excited for. But anyway, right now all of our offices are closed. Everybody's remote. It's no problem. 60 or so, maybe 70% of our traders, something like that, were probably remote even before coronavirus hit. So we got great communication through the virtual trading floor and everything else. I'm still broadcasting my meetings. If anything, I think the communication has been better since we've closed our offices, which is kind of a crazy concept to think about. T3 is a registered SEC broker-dealer and member of FINRA SIPC. This means that after you pass registration and the background check, you can't be a felon or have declared bankruptcy in the last 2 years and join the company, you have to become licensed. There's 2 tests you have to pass. You have to pass the SIE, Security Industry Essentials, and you have to pass the Series 57 examination. We'll sponsor you for the exams. We'll provide you with study materials. We sign all of our incoming traders up for an STC study program. You get textbook, online classes, online practice tests, everything you need to pass. Once the exams are passed, and only when the exams are passed, can we get started trading professionally with the firm. For equities, we have 3 different trading software options: Lightspeed, Sterling Trader Pro, and Wolverine, also known as WEX. I think in futures they use Rhythmic. Personally, I use them and recommend Lightspeed. I've been on the software for over a decade. I think it's a great trading software, direct market access, charting, everything I need. Not too complicated either. Talked about this already, equities, futures, options on equities, options on futures. So what we do is, and I'll come back to this slide in a second. Once those exams are passed, you've been on the demo for a little bit, you're comfortable, you have to fund your account. So it's a first loss system. So you need to commit a capital contribution in order to trade with us. The amount of money that you want to come into the firm with is really, for the most part, up to the trader. What we do is we're going to provide buying power at 20 times your contribution for day trading and 8 times your contribution for overnight positions, and you'll be compensated through a profit split. So someone who joined the company with $50,000, we basically start by allocating them $1 million to work with. And again, reach out to me and we can discuss, individually the profit split and what your numbers would be and things like that. But those are our general starting numbers. And from there, we want to help you become as successful as possible. So, like I mentioned already, you're going to have access to my training program. If you're a brand new trader, the training program is great for you. Honestly, even if you're an experienced trader, I get great feedback from it because it's really going to reinforce your fundamentals and really help you with your rules-based approach to the market. But you're going to get a training program that's going to give you a strong foundational understanding of markets, and then you're going to build on that foundation by participating in our morning meeting, our afternoon meeting, our trading community, our virtual trading floor. Got a really strong group of traders that I'm working with, large degrees of experience. Some of them have been trading professionally for decades, former fund managers, former pit traders, former floor traders, all the way down to others who are more entry level, just getting their career started for the first time. Everyone's really friendly for the most part. We got a great community, and that will help you utilize that. Bounce ideas off of more experienced traders. Ask me questions. I love when people ask me questions because maybe you'll get me involved in an idea that I didn't know about. One of my better trades today, buying VXRT off the open, that was not my idea. I wasn't looking at VXRT. That stock was brought to me by one of the traders in the group. Now it's pulled back a bit, but the trader's off the open. Stock had some news. I've been in a solid daily chart consolidation. $7.50 was a clear level. Very simple trade. buy through 750, off the open, out on the trade is the opening low, 13 cents worth of risk. My price is a little bit late. I think I got a little bit above 750 on the entry. And for that 13 cents worth of risk, just gave this beautiful stellar move, pulled back definitely more than I would like, but I sold a large percentage of my position into this up move, and I'm only giving back, a smaller percentage of the position. That was not my idea. That was an idea that came from my community. So be a part of a community. We help each other to make money. We bounce ideas off of each other, and that's what you'll get with us: education, meetings, community, and most importantly, the capital access of being a professional trader. And again, we do have retail trading accounts as well. Retail accounts are generally pretty straightforward because they're subject to certain SEC rules like Reg T and the pattern day trading rule. So that limits margin and it limits day trading access for smaller accounts. Our edge in retail is that you still get all this education I'm talking about for free. You get to be part of my group for free, but you get direct market access. So we do not sell anyone's orders out to HFT firms like almost all of the online brokers do in this day and age. So again, if you're interested in any of this stuff, and you get all this other free stuff just by having an account with us, right? Access to my VTF, access to Redler's VTF, access to Redler All Access, access to my training program. Again, what we want is for our traders to be successful. If you are a successful trader, if you're making money for yourself, you're making money for the firm. That's what's most important. It's very straightforward. Reach out to me. Here's my email address. Happy to chat with anybody about any of this stuff. Opening up a prop account on any of our products, opening up a retail account. For whatever reason you did not want to open an account, you can even purchase a subscription to the virtual trading floor and be involved with my team anyway. So that's an option for you also. And that is it for this week. Thanks, everybody. Again, here's my email. Reach out. I've got 22 positions open or so. I think I closed my Uber position. I think my target got hit while we were having our conversation. So I'm going to get back to that and see what's going on with my trades and manage my positions. So have a great rest of your trading day, everybody.